The investment became more profitable every time someone died. A group of strangers pooled their money, each purchased a share, each expected steady income. But the rules contained a hidden incentive. When one member died, their payment did not pass to family. It was redistributed to the survivors. The fewer people remained, the larger the payouts became. Eventually, only one investor would remain, and that person would collect everything. This structure had a name, the Tontine. Governments used it to raise money. Insurance companies expanded it into massive investment programs. Millions participated. Few understood the incentives built into the system. Because in a tontine, survival was profitable, and death increased the returns. This is the story of the tontine scheme. In the 17th century, European governments faced a growing financial problem. War had become extremely expensive. Standing armies required constant funding. Fortifications demanded continuous construction and maintenance. Naval fleets required timber, cannon, and trained crews. Campaigns lasted for years rather than seasons. This shift dramatically increased government spending. France faced the greatest pressure. Under King Louis XIV, the French monarchy pursued territorial expansion. The crown financed wars across Europe. Conflicts against the Dutch Republic, Spain, and the Holy Roman Empire consumed enormous resources. Maintaining dominance required a permanent military presence. Tens of thousands of soldiers required wages. Supply chains required horses, carts, and provisions. Gunpowder and artillery had to be manufactured at scale. These expenses accumulated faster than traditional revenues. Taxation remained the primary income source for European monarchies, but taxation had limits. Peasants and merchants were already heavily burdened. Additional taxes risked political unrest. Tax collection itself was inefficient. Local officials often diverted revenue before it reached the crown. Large portions of national income never reached the treasury. Borrowing became the alternative solution. Governments issued debt to wealthy financiers. Merchants, bankers, and nobles purchased government obligations. In return, they received promises of future interest payments. These arrangements temporarily solved cash shortages, but the debt accumulated rapidly. Interest payments began consuming a large share of state revenue. Some governments defaulted on their obligations. Others delayed payments for years. Investor confidence became unstable. Financial markets in Amsterdam, Paris, and London began reacting to government solvency. States needed a new method to raise capital. Traditional loans were becoming increasingly difficult to secure. Investors demanded higher interest rates. Governments searched for structures that could attract large pools of money. They needed systems that appeared safe and profitable. The solution would combine investment, survival, and time. It would transform mortality into financial mechanics. The proposal had not yet appeared, but the fiscal pressure was already building. European governments were desperate for new funding mechanisms, and fiscal desperation often produces financial innovation. By the mid-17th century, European governments were actively searching for new financing mechanisms. France faced particularly intense fiscal pressure. Continuous warfare had strained the royal treasury. Traditional borrowing channels were becoming unreliable. Investors increasingly doubted the state's ability to repay loans. Interest rates demanded by lenders continued to rise. In this environment, new financial ideas attracted attention. One such proposal came from an Italian banker. His name was Lorenzo de' Tonti. In 1653, Tonti presented an unusual financial structure to the French monarchy. The proposal attempted to solve the government's funding crisis. It offered a way to raise large amounts of capital quickly. The structure combined elements of annuities and pooled investment. Participants would contribute money into a collective fund. Each investor purchased a share in the pool. The government would then invest or use the capital. In return, participants received regular payments.
These payments functioned like an annuity. However, the structure included a distinctive feature. The payments did not remain fixed over time. Instead, they changed depending on survival. When a participant died, their share did not pass to heirs. Their portion of the payment was redistributed to surviving members. Each death increased the payments received by the remaining investors. Over time, the pool contained fewer survivors. As the number of participants declined, payouts increased. Eventually, only a small group of survivors remained. In some structures, only one investor would remain alive. That final survivor would receive the entire remaining income stream. From the government's perspective, the system offered advantages. The state received a large upfront payment from investors. In return, it paid annual income rather than repaying principal. As participants died, the number of payments gradually declined. This reduced the long-term financial burden on the government. The design transformed mortality into a financial mechanism. For investors, the structure appeared attractive. Initial payments provided predictable income. Long-term survival offered the possibility of very large returns. The longer an investor lived, the more profitable the investment became. The proposal therefore combined gambling with long-term finance. Lorenzo de Tonti argued that the system would attract widespread participation. He believed investors would be drawn to the rising payouts. The French monarchy examined the proposal carefully. Officials recognized the potential to raise immediate capital. However, implementing such a system required public trust. Participants needed confidence that payments would be honored. Despite these uncertainties, the concept gained attention. Financial innovation often emerges during periods of fiscal pressure. The Tontine proposal represented a new form of financial engineering. It turned longevity into a market variable, and it offered governments a creative method to fund their debts. A tontine was built around a simple financial structure. A large group of investors contributed money into a shared pool. Each participant purchased a financial share in the system. The total capital collected formed the investment fund. This fund was usually managed or guaranteed by a government. In return, investors received annual income payments. These payments resembled annuities, but the distribution rules were very different. Participants were divided into age-based groups. Each age group formed its own tontine pool. Younger investors were grouped together. Older investors were placed in separate pools. This structure helped balance survival probabilities. Each participant received an initial annual payment. The size depended on the original investment. At the beginning, payouts were modest, but the structure changed over time. When one participant died, their payment stopped. That share did not transfer to heirs or family members. Instead, the payment was redistributed. The surviving members of the pool received the additional income. This meant every death increased the payouts for survivors. As time passed, the number of living participants declined. The pool gradually became smaller. The annual income for remaining members grew larger. Those who survived longest received the highest returns. This created a powerful financial incentive tied to longevity. Investors were no longer earning returns only from capital. They were also earning returns from survival. The mathematics of the system were straightforward. Fewer participants meant larger shares of the payout pool. Eventually, the number of surviving investors became very small. Sometimes only a handful of people remained. In extreme cases, only one investor survived. At that point, the final participant received the entire payout stream. This outcome made the tontine financially dramatic. Some survivors received extraordinary income late in life. Early deaths, however, produced no inheritance for families. The investment effectively vanished from the estate. This feature made tontines fundamentally different from traditional annuities. The design encouraged long-term participation. It also introduced unusual psychological incentives. Participants became financially aware of the deaths within their pool. Obituaries and death records became financially relevant information. Each death represented a change in the payout structure. This dynamic created fascination and discomfort among the public, yet the structure remained mathematically efficient. Governments could raise large sums of money quickly. Investors received the possibility of increasing returns. The entire system depended on survival probabilities, and the incentive structure was built directly into the design.
During the late 17th century, European governments began experimenting with tontine financing. France was among the earliest adopters. The monarchy needed immediate capital to sustain military campaigns. Traditional borrowing was becoming increasingly expensive. Tontines appeared to offer a practical alternative. Investors were attracted by the promise of rising payouts. The French government introduced several tontine programs. Participants purchased shares directly from the state. The capital collected flowed immediately into the royal treasury. In return, the government promised annual income payments. These payments followed the tontine survival structure. As participants died, the remaining investors received larger shares. For the monarchy, this structure solved several problems. Large sums of money could be raised quickly. Repayment of principal was not required. Payments declined naturally as participants died. This reduced long-term financial obligations for the state. Other European governments soon noticed the model. Britain began exploring similar financial structures. Dutch financial institutions also examined tontine systems. The Netherlands already possessed sophisticated financial markets. Investors there were familiar with government annuities and bonds. Tontines offered a variation that combined investment with longevity. Financial brokers helped promote these programs. Printed pamphlets explained the potential profits. Tables were sometimes published showing projected payouts. These tables demonstrated how surviving investors could receive substantial income. The longer participants lived, the greater the rewards appeared. This feature made tontines particularly attractive to certain investors. Some participants believed they possessed unusually long life expectancy. Healthy individuals viewed survival as a financial advantage. Wealthy families sometimes enrolled multiple members. This increased the probability that at least one relative would survive. In some cases, entire social networks joined the same pool. Friends and associates invested together. The social dimension of tontines became widely discussed. At the same time, governments appreciated their fiscal efficiency. Tontines transferred longevity risk away from the state. Instead, that risk was absorbed by the participants themselves. The structure functioned as both investment and demographic gamble. Early adopters celebrated successful survivors. Stories circulated about elderly investors receiving enormous annual income. These stories encouraged further participation. The system therefore spread gradually across financial centers. European governments continued experimenting with the model. Not every tontine succeeded as planned. Some pools contained unexpected demographic patterns. Others generated public criticism. Nevertheless, the concept demonstrated remarkable flexibility. It could function as public finance or private investment. By the 18th century, tontines had become a recognized financial instrument. Government endorsement accelerated public confidence, and state backing helped transform the tontine into a mainstream investment structure. As tontines expanded across Europe, their incentive structure attracted growing scrutiny. At first, the system appeared mathematically elegant. Investors pooled their money. Governments received immediate capital. Survivors gradually received larger payments. But the mechanism produced an unusual moral dynamic. Financial returns were linked directly to death. Every participant understood the arithmetic. When another member died, payouts increased. This meant the fortunes of investors improved as others disappeared. Most participants treated the structure as a simple financial gamble. Longevity was unpredictable. Deaths occurred naturally over time. However, observers began noticing the psychological implications. Participants sometimes followed the health of other investors closely.
Newspapers occasionally reported the deaths of Tontine members. In some cities, surviving participants tracked mortality updates. Each announcement changed the payout calculations. As the pools shrank, the stakes increased dramatically. Late survivors could receive extraordinary income. The financial reward for outliving others became substantial. This feature generated public unease. Critics argued the structure encouraged unhealthy incentives. A system that rewarded survival might appear harmless, but a system that rewarded the death of others seemed unsettling. Philosophers and clergy began debating the morality of tontines. Some described the system as financialized mortality. Others worried about potential abuse. Stories circulated about suspicious circumstances. Rumors occasionally spread about participants dying unexpectedly. Most of these stories lacked evidence, but the mere possibility disturbed many observers. Insurance and financial markets depend heavily on trust. Any suggestion of manipulation threatened public confidence. Governments also began recognizing reputational risks. A financial instrument associated with death could provoke backlash. At the same time, investors remained fascinated by the payouts. The arithmetic continued to attract participants. Older survivors sometimes received dramatic income increases. Public fascination with these outcomes persisted. Yet the structure revealed a deeper principle. Financial incentives shape behavior, even when no wrongdoing occurs. Designing systems that reward specific outcomes can influence decisions. Tontines transformed longevity into a financial competition. The structure rewarded survival and indirectly benefited from death. For many observers, that incentive felt uncomfortable. The debate surrounding tontines continued to grow, and the tension between mathematics and morality became increasingly visible. Financial systems may appear neutral, but incentives embedded within them can shape human behavior.
By the late 19th century, the tontine structure crossed the Atlantic. The United States was entering a period of rapid industrial expansion. Cities were growing quickly. Personal wealth was increasing. Financial markets were becoming more sophisticated. Insurance companies saw an opportunity. They began adapting the tontine model into life insurance products. These products became known as tontine insurance policies. The concept appeared attractive to the public. Policyholders would pay regular premiums. Their payments accumulated within a shared insurance fund. Unlike ordinary insurance, the payouts were delayed. Participants agreed to wait many years before receiving dividends. These waiting periods often lasted 20 years or more. During this time, the company invested the accumulated capital. Policyholders expected significant payouts at the end of the term, but the structure included a critical condition. Only policyholders who maintained their policies until maturity received dividends. Anyone who stopped paying premiums forfeited their accumulated share. Deaths during the term also removed participants from the pool. As policyholders disappeared, the remaining participants benefited. The structure closely resembled the original tontine mechanism. Insurance companies began marketing these policies aggressively. Advertisements promised disciplined saving and future wealth. Agents emphasized the possibility of large maturity payments. Middle-class families became enthusiastic participants. Millions of Americans purchased tontine insurance contracts. By the 1890s, the system had grown to enormous scale. Major insurance companies held vast reserves of tontine funds. Companies such as Equitable Life and New York Life expanded rapidly. Executives praised tontines as a revolutionary financial product. The policies appeared to combine savings, insurance, and investment. Participants believed they were building long-term security, yet few fully understood the structure. The delayed dividend system was complex. Policyholders rarely saw detailed accounting reports.
Most trusted the promises made by insurance agents. Meanwhile, companies accumulated enormous pools of capital. Premium payments flowed in continuously for years. Funds could be invested in railroads, real estate, and bonds. Insurance companies became powerful financial institutions. Their investment portfolios expanded dramatically. Executives gained significant control over these funds. Public enthusiasm continued growing through the 1880s. The Tontine insurance model became the dominant life insurance product in America. Millions of policyholders depended on its promised returns. But the complexity of the structure concealed important details. Financial innovation had scaled rapidly through the insurance industry, and the incentives within the system were not always transparent.
As Tontine insurance expanded across the United States, enormous pools of money accumulated inside insurance companies. Policyholders continued paying premiums for years. Most of these funds remained locked inside long-term Tontine contracts. Dividends would only be distributed after the maturity period ended. This structure created a long delay between payments and payouts. During this time, companies controlled the capital. Insurance firms invested the funds across expanding American industries. Railroads, government bonds, and urban real estate became common investments. These investments often generated substantial returns, but policyholders had little visibility into how the funds were managed. Accounting systems inside insurance companies were complex and opaque. Detailed financial disclosures were rarely provided to policyholders. Many investors assumed their money was accumulating safely. However, the Tontine structure created an additional advantage for companies. Participants who stopped paying premiums lost their accumulated contributions. These policy lapses were common. Economic downturns, illness, or unemployment often interrupted premium payments. When a policyholder lapsed, the company retained the entire accumulated value. This meant the remaining participants indirectly benefited, but the company also gained financially. Large portions of Tontine pools came from forfeited policies. Executives began realizing the scale of these profits. Internal accounting records revealed large undistributed reserves. Insurance companies accumulated vast financial surpluses. Executives controlled these reserves with minimal external oversight. Some companies began funding lavish executive lifestyles. Corporate offices became increasingly luxurious. Senior executives received unusually high salaries. Corporate governance inside the insurance industry became increasingly concentrated. A small group of executives controlled enormous financial resources. Meanwhile, policyholders rarely understood how their money was being used. The complexity of Tontine accounting concealed important information. Even regulators struggled to interpret some financial reports. Public awareness of these issues remained limited at first. Most policyholders continued trusting the companies managing their savings. Advertisements continued promoting the promise of large future payouts. But internally, insurance companies were becoming powerful financial empires. The Tontine structure had unintentionally created enormous corporate reserves. These reserves provided executives with significant influence. Over time, critics began questioning how these funds were managed. Financial journalists started examining insurance company balance sheets. Investigations slowly revealed the scale of undistributed profits. Questions about fairness and transparency began emerging. Policyholders wondered how much of the returns truly belonged to them. Financial innovation had produced a powerful investment machine, but the internal incentives increasingly favored the institutions controlling the funds, and the gap between policyholder expectations and corporate realities continued growing. By the late 19th century, questions about Tontine insurance began circulating more widely. Policyholders started examining the structure more closely. Many realized they had little information about how their money was managed. Annual reports provided only limited details. Dividend calculations remained difficult to understand. The delay between premiums and payouts created uncertainty. Some policyholders had paid into the system for many years,
yet they still had no clear estimate of their final return. Financial journalists began investigating the insurance industry. Newspapers started publishing articles about Tontine policies. Writers questioned how companies calculated future dividends. Some reports suggested that accounting practices were intentionally unclear. The public began noticing the enormous wealth accumulated by insurance executives. Corporate offices became increasingly extravagant. Insurance company headquarters expanded into impressive buildings. Executive compensation also became a topic of discussion. Some executives earned salaries that appeared unusually large. At the same time, policyholders waited decades for payouts. This contrast drew increasing attention. Financial reform advocates began studying the industry. They suspected the Tontine system concealed structural imbalances. Policy lapses became a central concern. Many participants failed to maintain premiums for the full contract term. These forfeited policies generated large gains for the companies. Remaining policyholders also benefited indirectly, but the overall distribution of profits remained unclear. Policyholders began asking questions at shareholder meetings. Agents sometimes struggled to explain the accounting formulas. Complex actuarial tables made independent verification difficult. Public trust slowly began to weaken. The insurance industry responded by defending its practices. Executives argued that Tontines encouraged disciplined saving. They claimed long-term contracts protected policyholders from short-term speculation. Companies emphasized the success stories of surviving participants. These stories highlighted individuals receiving large maturity payouts. Yet critics argued these cases were exceptional. Most participants would never experience the largest returns. Financial transparency became a growing demand. Journalists and reformers pushed for greater disclosure. Insurance contracts were increasingly examined by legal experts. Questions about fairness and accountability intensified. Public suspicion gradually expanded beyond individual companies. The entire Tontine model came under scrutiny. What had once appeared as an innovative financial product now raised concerns. Financial systems depend heavily on confidence. When transparency weakens, trust begins to erode. By the end of the century, that erosion was becoming visible, and growing suspicion prepared the ground for formal investigations. By the early 20th century, pressure for oversight had intensified. Public trust in the insurance industry had weakened. Journalists continued publishing investigations into Tontine policies. Policyholders increasingly demanded answers. Politicians began responding to the growing concern. Government officials recognized the scale of the insurance industry. Millions of Americans depended on life insurance contracts. Large portions of household savings were tied to these policies. Regulators could no longer ignore the controversy. One of the most significant investigations began in New York. In 1905, the New York State Legislature launched a formal inquiry. The investigation became known as the Armstrong Committee hearings. The hearings examined the practices of major insurance companies. Executives from leading firms were called to testify. Companies such as Equitable Life, New York Life, and Mutual Life appeared before investigators. Lawmakers examined company accounting records in detail. Financial statements revealed enormous undistributed reserves. Insurance companies controlled hundreds of millions of dollars. Much of this capital came from Tontine insurance premiums. Investigators also reviewed executive compensation. Some executives received salaries far beyond industry norms. Corporate spending attracted particular criticism. Companies had funded extravagant offices and social events. Executives maintained luxurious lifestyles funded by corporate accounts. Political donations from insurance companies also attracted attention. Investigators discovered that some firms had influenced elections. Insurance money had quietly entered political campaigns. This raised serious concerns about corporate power. Policyholders had never approved these expenditures, yet their premiums funded the system. Public reaction to the hearings was intense. Newspapers published daily coverage of the testimony. Details about executive privileges shocked many readers. The scale of corporate control over policyholder funds became widely known. Regulators concluded that the Tontine system encouraged excessive concentration of capital. Executives controlled enormous financial reserves with limited oversight. The complexity of Tontine contracts prevented meaningful transparency. Most policyholders could not verify how dividends were calculated. This imbalance between institutions and customers became politically unacceptable. Reformers argued that the system required stronger regulation. Insurance markets needed clearer rules and disclosure standards. Financial institutions needed stricter accountability. The Armstrong investigation, therefore, became a turning point. It exposed the structural weaknesses of Tontine insurance. Public trust in the model declined rapidly. Lawmakers began preparing reforms that would reshape the industry. Oversight had arrived only after the system had reached enormous scale, and the investigation revealed how financial innovation can expand faster than regulation.
Following the Armstrong investigations, political pressure for reform increased rapidly. Lawmakers concluded that the Tontine structure required major changes. The system had concentrated enormous financial power inside insurance companies. Policyholders had limited visibility into how their money was managed. Executives controlled vast reserves with minimal oversight. Public confidence in the industry had weakened. Regulators began drafting new insurance laws. These reforms targeted the structure of Tontine policies directly. Several states introduced legislation restricting their use. New rules required greater transparency in insurance accounting. Companies were forced to publish clearer financial reports. Dividend calculations became subject to regulatory review. Insurance firms could no longer operate Tontine pools without scrutiny. Some states moved further. They prohibited the sale of new Tontine policies entirely. The original Tontine structure depended on delayed dividend distribution. Regulators viewed this delay as a major source of abuse. Long waiting periods concealed the true financial flows inside companies. New legislation shortened dividend distribution timelines. Policyholders gained greater access to information. Insurance contracts were simplified. Complex survival pools became harder to justify legally. As reforms expanded, insurance companies adapted their products. Traditional life insurance policies replaced Tontine contracts. These new policies provided clearer guarantees. Policyholders received defined benefits and clearer dividend structures. The dramatic survival incentives of Tontines disappeared. Companies shifted toward more transparent financial models. By the early 20th century, the Tontine era was ending. New policies emphasized stability rather than survival competition. The insurance industry entered a period of modernization. Regulatory frameworks became more sophisticated. Financial reporting standards improved gradually. Government oversight expanded across financial markets. The collapse of the Tontine model was not caused by a single scandal. Instead, it reflected structural weaknesses exposed over time. Financial innovation had moved faster than regulation. Once oversight arrived, the system proved difficult to defend. Public trust had already eroded. Companies abandoned Tontine products to protect their reputations. New generations of investors rarely encountered the system again. Yet the core concept did not disappear entirely. Financial structures linking survival and payouts continued evolving. Modern pension systems and longevity pools share similar mechanics. The Tontine model therefore left a lasting legacy. It demonstrated how incentives can shape financial behavior. It showed how complex contracts can conceal institutional advantages, and it revealed how regulation reshapes markets after structural problems emerge.
The Tontine did not disappear because the mathematics failed. The mathematics actually worked exactly as designed. Capital was raised efficiently. Payments adjusted automatically as participants died. Governments reduced long-term debt obligations. Insurance companies accumulated enormous financial reserves. From a purely structural perspective, the system functioned. The problem emerged from incentives. Financial systems do not operate only through numbers. They operate through human behavior. The Tontine structure rewarded survival within a group, but it also meant that deaths increased payouts. Participants rarely focused on this feature when joining. Most investors expected steady income and long-term savings. Few fully examined the incentive mechanics. Yet those mechanics shaped the system's outcomes. Over time, the structure created tension. Participants benefited indirectly from the disappearance of others. Institutions benefited from complexity and delayed payouts. Transparency weakened as contracts became harder to interpret. Public trust gradually eroded. When the system finally faced investigation, the incentives became visible. Regulators concluded that complexity had concealed important realities. Financial products often appear safe when first introduced. Early participants experience positive outcomes. Success stories circulate through markets. These stories attract more investors. But complex systems can hide long-term imbalances. Tontines demonstrated how financial engineering can reshape incentives. The same principle appears repeatedly in modern markets. Retirement systems often pool longevity risk. Pension funds distribute payments across large populations. Some structured financial products also depend on survival probabilities. The mathematics remain similar to the Tontine logic. However, modern systems emphasize transparency and regulation. Participants receive clearer disclosures. Oversight attempts to prevent hidden incentives from dominating outcomes. Yet the core lesson remains relevant. When incentives are poorly understood, participants may misjudge the system they enter. Financial structures can quietly reward outcomes investors never intended. The Tontine, therefore, represents more than a historical curiosity. It illustrates how innovation emerges during fiscal pressure. It demonstrates how incentives shape financial behavior, and it reminds markets that complexity can obscure the true mechanics of profit. Understanding incentives is therefore essential to understanding financial systems, because the structure of a system determines the behavior it produces, and the Tontine showed how survival itself could become an investment strategy.